I think it's recording now. Okay, so let me repeat. Hi, and thank you for coming to my pretty advanced presentations. And it's been a while. As probably, I mean, same for all of us. I mean, it's been a pretty hectic market. I had to roll. March did, I mean, I broke even on March. I'm very happy, yeah. But April is a bit of hard work. Okay, options mechanics 12. Last time, and can't remember how long ago that was, but I explained that backtesting is by and large a waste of time. There are some benefits, especially learning, but I invite people to really get their fingers into stats. It's not as complicated as people think, and I'm not going to go back into backtesting and the lack of significance or reliability. Incidentally, it's also a topic of the moment with those COVID-19 studies. Anyway, so I thought that with the huge vol spike that we had, it would be interesting to look at something that I used to look at very closely in my quant years, and maybe that will spur your curiosity. And that's all about GARCH 1.1 or 1.1. And I'm going to introduce you to that, and also hope by the end of this presentation you will understand why it is important. Okay, so no need for the long disclaimer. It is obviously educational, and as you know, this is not a train course. I mean, topics come really from the top of my head, and this time it is really, although I'm not going to give you an option specific technique. It is actually related to the very weird market that we are going through at the moment. So today, further ramblings on stats, and I'm going to try and make it as easy as possible. I'm not going to go into very complex mathematics, but today's topic is that very long name, heteroskedasticity. Normally, if it was a course, I would introduce, and I would probably have started with skew, kurtosis, and sigma, all those things. But you know, my presentation come in any random order. So let's just talk about one topic, and if it generates some curiosity, I can obviously go into other stats topics later. So what does that long word mean? Hetero means different, and skedasis means dispersion. And when we have something that goes very far away from the mean, like we've seen recently, we may ask ourselves questions: what caused that dispersion? And so the first thing is that you can look at. I will provide, for those who want, I will provide the spreadsheets for the charts I'm using today. So the first thing you can look at is the log return dispersion. Of course, there's a lot of occurrences around the mean or very small variations day to day, and you've got those black swan or white swans or really large moves. But the dispersion is there. We know that the price distribution is a Mexican hat, you know, with fat tails. We know all of that, and we know it's very difficult to model that random behavior or extreme behavior. But what we can try and see is try and explain dispersion, and there are various ways to look at this, and that's typically what is called heteroskedasticity. So what is this? Oops, yeah. And first, I'm plotting here the daily return scatter plot on the SPX, and we see that, well, you know, we've got the normal volatility points, you know, I mean, this is, I think, from early 2018 to now, and really the market really went very, very bizarre in the last month. And we probably all know why, but in terms of math or data, how can we explain it? And we were going to see that heteroskedasticity is there, but this plot does not explain it, and it does not even exhibit it, because it's just a plain dispersion. We know the market went crazy. Now, how do we define heteroskedasticity? Even myself, I mean, I've practiced the word heteroskedasticity. So generally, we try and explain the dispersion with an additional variable or additional variables. It can be more complex, multidimensional, but let's just take a simple example where you try and find some variable that explains that odd dispersion. And generally, we try and look at whether volatility, as expressed by VIX, for example, can explain the dispersion. And we know there's a correlation between VIX and SPX. But if you have any understanding of stats, you must always keep in mind that correlation is not a causality. There's no reason to believe that VIX drives SPX or vice versa. They are independent, fairly independent, anti-correlated phenomena. So now if we look at an example, and that has nothing to do with trading, but heteroskedasticity, for example, income versus age. We've got income and we use a dependent variable, which would be age. Yes, we can understand, and it's always good to try and find a meaning, an explanation, not just analyzing numbers. And we can, of course, understand that generally, as you grow older, you accumulate a bit of wealth, you've got a better job, and you make more money. And so we can understand that there can be a dispersion in this income versus age chart. But now for financial data, that is actually more complicated. So as I've just said, the VIX cannot be, or generally is not, a dependent variable for the dispersion in prices, and certainly not on a day-to-day basis. So either we look for some variable or variables to explain that dispersion, and they can be random, like a random event like that COVID-19 or the war against China, whatever the reason, we can try and figure out. And maybe, and I'm sure, I mean, I'm going to go into explaining why GARCH is a good model. And I will also, I mean, again, I would like you to be curious enough to go deeper, because GARCH is a model that can be used for trading, directional trading. And GARCH is also a model that tends to work well in times of volatility spikes. So maybe, and again, I'm not going, it's not a workshop where I'm going to be talking for hours about GARCH. I mean, I'm just, you know, I'm trying to instill some curiosity and interest. But you will see that there are good models. Unfortunately, those vol spikes come generally randomly, fewer and further apart. We don't exactly know when they happen, but maybe they can be used to detect what's coming on, what has come up in the market, and it could be also used to trigger, for example, a hedging strategy, if not a typical trading strategy, buy-sell strategy. But I invite you, maybe I will try and find a few links, but it's actually interesting that there are pretty good GARCH trading models that do work well, but they do work well in terms of extreme volatility. So again, I can come back to what I said about backtesting. There are generally, if you look at, for example, 5, 6, 10 years of data, you have only a few occurrences of, I would say, GARCH triggers. They do work well, but you don't have enough evidence that a GARCH trading strategy will be stable over the long run. And the converse of what I've just said is that GARCH will probably not work well when volatility drops into a more noisy environment where it's business as usual. So that can be an extra tool in your panel of instruments and technical analysis or statistical tools, but just be careful when you use heteroskedasticity and GARCH. So as I said, just heteroskedasticity requires a dependent variable. There are some studies that show everything and its contrary when it comes to me. I mean, it sounds like VIX could be that dependent variable, but really the jury is still out on that. Again, it's not clear whether that works. What is actually interesting when you study heteroskedasticity and you have that lack of dependent variable is that we are going to look at autoregressive models. We are going to look, well, we're going to use SPX and the dependent variable will be SPX as well, just a lagged version of SPX. So we are looking for, and that can be, that's why I said that maybe a good preliminary study would have been other autoregressive models, moving averages, or where you try and figure out trend or some relation between the environment and the previous environment. And actually the reason why I came, that studies really, this topic really popped up in my mind is that we have seen in the last month or 6 weeks or 2 months, very weird volatility behavior. I mean, if you look at the market dropping and VIX going through the roof, I would say that's business as usual. You generally know what you have to do. You hedge, you roll back, okay. It's nerve-wracking, but it's actually, for many strategies, fairly easy to deal with. And as I said, when I started this presentation, I managed to make a little bit of money on the March cycle, which it was hard work, a lot of rollbacks, but a lot of hedging, but at the end of the day, I made some money. April is another ball game, and that's the reason why I had to cancel a few stations. And actually I had to roll the April expiration to month end, and I may even have to roll to May. But you can't roll forever. I mean, at some point you have to take losses, but that's another story. So the point from now on is to figure out a model where you use volatility or variance, and the standard deviation or variance is a measure of volatility. And you try and figure out whether there's a time relation or an autoregression, or there's something that can explain the clustering that we've seen. The market went down sharply, volatility went up, and what we've seen is that we've had an extraordinary recovery since, I don't know, 3-4 weeks ago. Market, I'm going to mention SPX because this is my favorite symbol. Market SPX hit 2175, if I'm not mistaken. Now it's hovering over 2800 or 2850. This is an amazing recovery, and volatility tends to be sticky. So not only we have a whipsaw situation, but we have a whipsaw with lasting volatility effect, which is very unusual. And to be honest, in my long experience, I've never seen this before. I was not a trader in 1987. Fortunately, no, really, I can I can really try and look back many years. There's nothing. And generally, those random black swan events never look like each other. There's always something strange and new. Anyway, so there is something, and this visibly, I mean, this is obvious, just in front of our eyes. There's visibly some volatility clustering. What can we do about it? That's another story. Volatility provides opportunities. I mean, this is obvious that if in this whipsaw the volatility had crushed, the whipsaw would have been a lot more difficult to handle. So there are some positives in this market situation. But anyway, I'm not going to be digressing about the current environment, and I'm going to now look at, oh, well, that's another digression actually. This is the SPX-VIX correlation of daily log returns. And we've seen that, for example, here in February, March, when the market dropped, it was almost like a perfect storm. VIX went up. I mean, it was really like textbook. Again, I'm not saying it was easy, but it was as anticipated or as expectable. The real problem is what's happening in the recovery. The correlation dropped enormously. A week ago, it was almost uncorrelated. I mean, if you look at a correlation point of 25%, this is unheard of. This is crazy. That can happen. That can happen. I mean, it happened also in June, July 2019. I mean, but this, and maybe we can look at some similarities. I haven't actually looked into what really happened in 2019. But this correlation, again, that's not a sign of causality. It can just tell you something bizarre is happening, and maybe you try and revisit your strategies, because all those rule-based strategies, where you just relax, watch your delta, and you've got your standard adjustment. All those things generally don't work, and they certainly don't work when the market acts very, very weirdly. So let's have a look at another chart. This is the SPX-VIX behavior on a scatter plot. And so this is, here, this is the SPX move, and here, this is a VIX move. And what we see is that there's generally not such a strong correlation. There may be, I mean, the strong correlation is valid. I mean, I'm not going to go back to the previous plot, that is here. Yes, there's a correlation on nominal prices. But in terms of daily variations, and generally when you do stats, you try and turn your time series or data series into something that is called stationary. It makes the stats more valid. So it's, you work generally more on returns than actual prices. So this can be, I would say, a first glance, but you have to dig deeper and look at, I mean, work your time series to make it, I would say, more valid. And here, I can't say I am impressed. There is an anti-correlation, but again, there's dispersion. Dispersion we know, but the problem is how to explain it. And okay, I can send you a few links. Again, correlation, causality. I mean, this one does not explain the other. So I'm getting to what I mentioned a little while ago, is that we are going to now look at what we call conditional heterodiskedasticity, so which is a slightly more advanced autoregressive model. Basically, it's called generalized autoregressive conditional heteroskedasticity. So let's just call it GARCH because it's simpler to pronounce. And you may have heard, or you probably, I mean, in the literature, or I don't know. I mean, if you are curious, you must have heard or even played around with GARCH 1.1 or 1,1. This is the model. So it's not actually, I mean, I know some people tend to run away when they see an equation, but I mean, this is not so bad. It's just variance as explained with by past variance. And if we use GARCH 1, it's going to be n minus 1, so just the previous value, and the returns, and that omega is a drift. I mean, let's forget about omega right now. I mean, basically, we're trying to explain current volatility by past volatility and past returns. So, of course, compared to moving averages where you have one variable, I'm thinking, for example, of the exponential moving average, that looks quite simple. You have one parameter, which is equivalent to a number of look-back bars or time. Here you've got 3. Yeah, it's a bit more complicated, but it does give you. I mean, if you see that volatility can be explained by past volatility, you will find some explanation for the current clustering. And again, if you use GARCH and if you do your homework, I can tell you that GARCH does work well when there are some tremendous, crazy spikes like we've seen. I'm not saying that in this recovery where market is really, I mean, maybe the initial shock is easier to trade than now where the market is going up. Volatility tends to stick at higher levels, and a lot of people actually are subconsciously or not looking at, well, VIX is still around 40. The market has to reverse, turn south. Maybe it won't. Maybe this is a change of paradigm, a change of context, and the market and volatility at high levels will become the new norm. Who knows? So we are going to look at conditional volatility as the time-dependent model. And I'm going to show you a few graphs, and I won't have time to really go into the mathematical details, but for those who want to, I will send the, I just cooked up an Excel spreadsheet this morning, and I can send it to you. So I calculated GARCH on SPX, on the volatility, and there as well, it is no surprise that the volatility as explained by GARCH has gone crazy. It's gone absolutely crazy. GARCH will actually help you calculate what is called the unconditional standard deviation or unconditional volatility, which can be looked at more or less as a long-term volatility. Let's not forget that SPX and VIX and volatility in general tend to be mean reverting. And now that would actually support my hypothesis that we may stay in a fairly high volatility environment, basically a new norm or a new standard. If you look at 2018, 2019, people were thinking, a lot of people were saying, well, volatility will return to its long-term average. And if we look at 2017, 2016, when volatility was bottom, I mean, rock bottom, we thought, well, yeah, volatility will go back to its long-term average of on VIX, I don't know, 15, 16, 17. I would advocate now that it's too low. The new volatility is probably, or the new long-term average is more probably around 25% now. And this shock to the world finance and the world market will make it stick for a long time. So these tools, it can be complicated, but I'm trying to give some context, because as a matter of fact, this is very much linked to what's happening on the markets right now. But again, I really invite you to be curious. It's not as complicated. For those who don't want to go too far into the math, I will provide some spreadsheets. So, well, this is actually my last slide. So maybe let's have a look at the spreadsheet I made up this morning. This is the SPX from early 2018. This is very simple. This is price. This is the returns. I could have used the log returns here. It's generally slightly better because it's unbiased, but you can use just the normal daily return. And basically, since I'm here on this spreadsheet, you know that to resolve this equation, you will need to find those three parameters. Again, let's not delve too much into. I mean, there's some logic, as I said. I mean, this is an autoregressive model, so we try and figure out how volatility can be explained by past volatility. But okay, even if you don't want to really think too deep about this formula, all you need to know is that you need those three parameters: omega, alpha, and beta. And how are you going to, I mean, you can figure them out by experience, by trial and error. As I said, the little drift factor omega is actually fairly minimal. But for those who are not professional or proficient with Excel, you will have to use the solver. The solver is on the data menu. It's here, and to see it here, you will have to. It's an add-in. So you need to go to your add-ins. Where's that? Options, I think. Add-ins. Solver add-in. Yeah, you have to. I mean, it's a free add-in. I mean, you just have to enable it. And once you're there, the problem, so to say, has already been set up inside the spreadsheet. So you just have to go to data, solver, and here the changing variables are these ones. I need to figure out those parameters. I give a few constraints. I know that those variables must be between 0 and 1. You can play around with I mean, this is not, generally people use simplex, but I mean, the GRG nonlinear is actually slightly more powerful. And evolutionary is actually quite interesting because it uses genetic algorithms. That's a topic I like a lot. Anyway, so you just press solve, and it will, after a few seconds, it will give you. I mean, I did it just before. So this is the parameters. So you now have your equation ready. You have your parameters, and so you just have to calculate the variance of yesterday, and you can figure out whether there's a large autocorrelation factor. At this point, you see that beta, which is the link between this variance, today's variance, and yesterday's variance, is actually 72%. 72% or 73% of today's variance can be explained by yesterday's variance. I'm not saying it is ultra high, but it is worth noticing that there is that stickiness in terms of volatility. And one reason why I'm very much interested in studying volatility is that most of us market neutral traders, we trade. I mean, I think we are a bit deluded to think that we can trade using a simple delta rule. We are actually Vega traders. Vega should be our first concern. So if you have any insight how volatility is behaving, you can become a better trader. That's all I'm trying to say. And this spreadsheet also calculates the long run volatility. So this is quite interesting because when we talk about volatility mean reverting to what? Now we have some idea that, and I do believe that volatility will stay high for quite a while. And maybe it's time to change your trading strategies quite, I wouldn't say radically, but then will need to be shifted. A number of things that used to work won't work anymore. You don't trade a market with an average VIX at 15. And I mean, a lot of people made no money or even lost money in their low IV environment a few years back because it was too low. And I suppose at the time, the mean reverting potential was also subdued. Now I'm saying that on the opposite side, on the high side, the mean reverting will also be subdued and volatility will remain high. So for a lot of us, we have that kind of a wake-up call. It's time to rethink whether your strategies will work in a much higher volatility environment. To me, it's just a matter of adapting. I mean, adapt or die should be the motto for all options traders. But so to me, there's probably as many opportunities than threats. And threats or weaknesses is because you are complacent and you want to trade based on backtest or whatever people have told you. You want to trade the same way over and over. No. This is a good example that, okay. My last speech on backtesting was prior to COVID, and maybe, of course, this goes in my favor, so to say, because I've been saying that, well, you must think, you must analyze, and you must be very careful with stats. So I'm giving you a tool which is maybe advanced for many, but again, I'm trying to make it as simple as possible, and I will provide this spreadsheet for anyone interested. Okay, generally I talk for about 40 minutes, so that I'm done with that. I'm going to stop sharing, and now I can see the chat box. Yeah, okay. So if you have any questions, this is the right time. Oh, hi, Gary. Yeah, no, I started a bit late, so I hope you didn't miss too much. And this is being recorded anyway.
Yeah, I'm sorry. I got tied up. I was doing some trading and I forgot a thing. I really wanted to listen to this, but I'll go back and watch a recording because this is something I know nothing about, but it's I need to understand a lot more.
I think it's worth it. It can sound complicated. Any statistician would say, well, this is crap. I'm not going too deep enough. But we're traders, we're practitioners. So I'm just giving you a few cues. Now it's up to each and everyone to dig deeper. I really believe that if you have some idea of that vol stickiness or vol autoregression, and you have an idea of where the mean reversion will most probably take you to, and if you become aware that, yeah, it's time to revisit my strategy because market is just not the same anymore, and it will maybe never be the same again. So this is especially in a very crazy situation like we are in at the moment. And I'm not going to digress on politics, but I mean, this is just crazy. So either people give up, people say, well, this is just too much, or it's just too complicated. But if you want to stay in the game, you have to up your game as well. I mean, you have to learn a bit more. Fortunately, I was a quant. I never was a very talented statistician, but I mean, I know my stuff. I know enough. I specialize more in artificial intelligence, which is other non-parametrics tools, but maybe at some point I will discuss about that. So really, I would say that even if you're a directional trader, even if you don't even trade options at all, GARCH is probably among quants the flavor of the month. So it's worth, even for just curiosity or looking for a way to diversify, because You know, your market neutral trade techniques work most of the time, but not now. GARCH will be probably the total opposite. I'm sure that GARCH worked well early March. GARCH. So if you Google up GARCH-based strategies, directional strategies, you will find that it does work well on SPX at the moment. But not even talking about other trading strategies, I would say that by analyzing data a little bit more, knowing the stickiness, there's a lot of auto-regression in variance. So we know that variance calls or volatility calls for more volatility until it stops. So I'm just giving you an extra tool to play with.
Appreciate it.
No, I'm glad. I'm happy to help. Yeah, I know I've been very busy with my SOAP software. It's out, and it's yeah. I just wanted to do modeling. I mean, you remember, Gary, we talked about it. Now time flies. I mean, probably 2-3 years ago, and I'm happy. My vol surface is working. I've already explained what's in there in a previous session. Now it's all about making it nice and easy to use. But yeah, my SOAP is out. Yeah, and also I wanted to get it out of the way because I'm actually joining a prop trading firm in Barcelona next month. So basically I'm delivering some of my knowledge because I will be less and less available in the coming month. Yeah, I'm going to be a quant again. They are interested in that jelly stuff in between my ears, so that's cool. Okay, any questions? I mean, even if it's off topic, Gary, I mean, we don't talk that often. So if there's anything you want to discuss.
Not really. I guess just a kind of a sideline issue. I think you know that I use RTD for accessing real-time information. I also have found out here recently and started using TDA has an API that can be used for accessing real-time data, and that one is doesn't have all the crap you have to go through with TOS. So it's
is that the new REST API?
Yes.
And
I know. It works pretty well. I'm collecting just bid and ask on like about 8 securities now, and it's working pretty good. So
IB is also releasing a beta version of a REST API. I haven't looked at it yet. The good thing is about REST is it's actually a fairly simple protocol, and generally when it's simple, it doesn't break. For those I've traded Forex in the past. We can compare it to FIX, which is FIX is also a simple, straightforward, but quite powerful protocol to retrieve data or even send orders on foreign exchange. So the rest is definitely the way to go. But because I trade on IB, I'm waiting for more stability. I mean, it's still beta stage. So, but it will make things easier. And once I'm on my sub software is on rest, I mean, then it will open the door for, TOS support and others. Yeah. So that's definitely in the cards, but I'm waiting for more stability. I've spent so long to get this API right that no, I don't want to. Let's say I want to first reap the benefits or reap this initial release, maybe get feedbacks, add more features, and the API stuff will have to wait. Yeah.
Yeah, there's just too many variables and everything, right? Trying to keep everything lined up. My progress is very slow because all the details, having to keep straight.
No, but you've done quite a lot of interesting research on volatility. Now, does it help you trade better? Do you pick your spreads better with knowing where the vol surface is going, or?
I think maybe a little bit, but I'm very weak in the trading side of it. I seem to enjoy the technical side too much, and I, you
Well,
know, so.
no, but I mean, it's at some point it will pervade through your trading style. I believe that maybe RTT will behave better, or maybe it will behave not so well in this new environment. Things have to be revisited very, very deeply. It's like people talk that there will be a world after COVID. There will be trading after COVID.
Mm-hmm.
And I'm just saying that GARCH is one tool. Maybe I will explore more interesting tools about volatility and how we can extract information from the market. I know that it's people want, you know, quick and easy recipes. How does it, how to plug it in my RTT or X4, whatever. No, I'm not going that far, you know. It's, or if I go that far, it's going to be for my prop trading clients. But in any case, as a mentor, I've never been very enthusiastic about, you know, mouth feeding. I mean, I enjoy that people like you know, they enjoy learning, you know, digging, scratching the surface. That's the only thing I ask of people watching my stuff. I mean, you've got to do your own homework.
Mm-hmm.
Yeah. Anyway, I'm not very good at talking for too long. So if there are no further questions, I'm going to go back to my coding.
Okay, thanks, Bruno. Really appreciate it.
Yeah, thank you, Gary. And let's have a chat sometime.
Okay.
Okay.
Anytime.
Okay. Bye bye for now. Cheers.
Okay. Bye bye.